In the history of financial markets, we already took a brief look at what bonds are. In this lesson, we're going to take a closer look. Welcome to bond markets. In general, bonds are considered a safer investment and a lower risk investment than, for example, stocks. You can imagine that if you invest in a stock or you invest in a company, the likelihood of a company going bankrupt is a little bit higher than a government going bankrupt. So for this reason, they are considered lower risk. Another important thing to note is that when a company, for example, goes bankrupt and they need to pay money to their investors, bondholders get money first. Later, stockholders. So this is a small detail and an important aspect that makes bonds, again, lower risk. Another reason to go for bonds is that they provide a fixed income in the form of an interest rate. We'll have a look at that in a second. And in times of economic downturn, bonds are a way to preserve your capital. For example, a stock might go down 30%. Let's say the recent coronavirus panic on stock exchanges. Stocks went maybe down 20 to 30 to perhaps 40%. And that just doesn't happen to a bond. Prices of bonds just fluctuate less than stock prices do. And in that respect, they can help you preserve capital in extreme situations. Now, trading in bonds and holding bonds is generally reserved for institutional investors. And some you can find on exchanges, but most of them are traded over the counter, also called OTC. You will hear about this term throughout the course, via brokerages most often. Some features to discuss before we take a look at what a bond chart looks like by using our tool TradingView that you've created an account for by now, I hope. So in this example, we're going to look at a US government bond that has a face value of $1,000. Now the drawing is a little bit poor on my device, so please bear with me. And it can look like this. So a US government bond with a maturity date of 10 years. Now you're going to find a couple of things when we're talking about these bonds. First of all, the face value. It's going to be the value at the maturity date. That in this case is $1,000. Then for holding this bond, you're going to be paid interest, also called the coupon, from the times where it was actually a physical coupon. And that can be, for example, 5%. So you are paying the government $1,000 for this bond, and in return for holding this, you get a 5% interest. Now you have the option to hold this bond for 10 years. That is the maturity date, or the maturity date is somewhere in after 10 years. And this bond also has a price. Let's say, for example, $100. Now this price is subject to supply and demand. So if I want to protect my capital, I could say, okay, I want to have bonds, and I would like to have this 10-year government bond, and I want to buy it from someone, but I am not the only one. Let's say there is a crisis and there are 200 or perhaps 200,000 other buyers. What will happen is that the price of the bond will fluctuate and will most likely go up. And that is one way you can make money on bonds. You can trade them in between there. You don't really need to wait 10 years in order to get your money back, but you can trade them in the meantime. So, for example, if everybody flees to these bonds, this price could change to, for example, $120. And you could profit from that. One final aspect that we're briefly going to discuss here is the yield. Now, the yield is calculated by dividing the coupon payments, and let's say, for example, they are $50, dividing the coupon rate by the face value. So that's $50 divided by $1,000, and is in this case, as we had, the 5%. And that's all I want to discuss for now. Bonds are not really relevant to the rest of the course, but I think it's very, very wise to do some research in them and especially look at the yield and how you can use bonds to protect your capital during, for example, economic downturns. What does this look like in one of our tools? Well, let's just go to TradingView. Even without logging in, you can go to Markets and you can go to Bonds. And let's see that let's, for example, take the major 10 years. And then you get a chart where you can see a lot of information. Now let's filter on prices. Top right corner, there's a small button. You can select either prices or yields, and you can see what we've discussed. You can see the coupon, the interest that you're paid, the maturity date, the changes in the prices, the highs and the low of the prices, and there is some rating. We'll not go into that for now. Switch back to yields, and you can see the yields of each of the 10 years. Now, as bonds are one of the biggest instruments and biggest markets out there, this video definitely doesn't do it justice. It's not my expertise. I'm not specialized in bonds whatsoever, so I've gathered a lot of resources that will take you further into the world of bonds. I think it's important in order to shape your view on financial markets, and especially later, if let's hope so, if you're working with larger amounts of capital and that needs protection in certain circumstances, bonds are extremely crucial to achieving that. So as always, read the literature, check the external sources, and we've provided some cool clips that explain this a hell of a lot better than I probably do. But I will see you in the next lesson, which is going to be commodity markets.